Hi, welcome to PSI, Plan, Save and Invest. We all know how crucial it is to have money set aside for the short-term goals. Whether it is your emergency fund, which is useful at the time of job loss or critical health condition, or your cash down payment for flat or car which you are planning to buy within a year or 2 years, or you're waiting to just buy gold for your child marriage next year. The important point is to ensure this capital, this amount which you saved, the emergency fund, the first important requirement is to keep the capital safe, not to even lose 1 rupee also from the amount what we accumulated from our savings. So this is called emergency fund. So if you want to use this fund within a year or 2 years, you should ensure that you invest in a product which is capital safe and yields returns above inflation rate, so that you'll be happy that you didn't lose anything. For most of us, the immediate thought for these short-term goals is to just invest the money into savings accounts or fixed deposit. But there is an alternative and better investment opportunity that is called ultra-short debt funds. And why these funds are important, we'll discuss in this video. Now, before we deep dive into the concepts, there's a critical point I need to highlight right at the beginning. The entire discussion outcome about whether any investment is truly good for you hinges on your net effective income tax rate. That is, what tax rate you're going to pay at the end of the year to the government. If your net effective tax rate is higher than 15%, meaning you're falling into the brackets of 20% or 30% higher income brackets, you need to pay extra close attention. So let us quickly go through that. So if your net effective tax rate, that is what you're paying to the government after 1 year, is below 10%, if you're paying below 10% of net effective tax rate, then these investments like fixed deposits or savings account or even ultra-short debt funds, most returns stay above inflation, suitable for safe investing, no doubt about it. If your tax rate is between 10% to 15%, returns may match inflation, still it's okay, acceptable for short-term needs. But in case if your net effective tax rate is crossing more than 15% and 20%, returns start to fall below inflation, use consciously, consider tax effective options. In case if it is 20% and 30%, post-tax returns often lose value versus inflation. Purchasing power erodes, not ideal for long-term investing, because you'll end up paying more tax to the government from the returns what you accumulated investing in this ultra-short debt funds or fixed deposits or savings account. So, but there is another option which is available for ultra-short debt funds, which is not available for fixed deposits. So that point also we shall discuss in this video in the later part. So what we will cover in this video, the true advantage and disadvantages of each option for your emergency fund, down payment or short-term goals or your cash holding needs, and why ultra-short debt funds recently delivered above average returns, and if that continue. This is $1 million question. We should know why ultra-short debt funds are better than fixed deposits and how they delivered above average returns from past few years, and also we should understand whether it will continue or not. That's very, very important. A crucial tax benefit of ultra-short debt funds. This is the actual point which I want to discuss in this video. There is a tax benefit over fixed deposits to the ultra-short debt funds. That also we shall discuss in this video. And a real picture of risk coverage of bank deposits, like fixed deposits and savings accounts have a risk coverage. They carry certain risk. So we shall discuss that also in this video. First, a quick recap of our comparison. Savings accounts, you know what it is. Bank account daily use, 2.5 to 4% is the returns. A liquidity, anytime you can withdraw, best for daily spending, very short term parking. and risks, we'll cover this in later part. Fixed deposit lock-in period with fixed interest and returns are between 5.5% to 7%, but now we can't expect more than 6% because interest rate cuts are going on. So yeah, we should be cautious about that as well. Liquidity penalty, fixed deposits attracts penalty. Like suppose if you're liquidating your fixed deposit before expiry, that is called premature liquidation, then you attract a penalty. Already the return is very low, somewhere between 6%, and if they charge 0.5% or 1% on the premature liquidation, then your returns get hampered. That's one disadvantage fixed deposits have. Best for known future expenses. If you want some amount within 1 year or 2 years and you want to keep your capital safe and earn money returns above inflation rate, then fixed deposits are suitable. But there is another alternative option which is called ultra-short duration fund. This fund, primarily what happens is it is managed by the professional fund manager. He or she will invest in investment products with the maturity of 3 to 6 months. That's it. So the risk is very much low. So the capital is almost safe. Even it is as safe as fixed deposit, because the maturity of the investments are debt instruments, and the maturity is 3 months or 6 months. So every 3 months and 6 months the churning happens. So if the maturity is for a long period, 2 years, 5 years or 10 years, the default, the chances of default is high, because the companies or the person who borrowed the money, the company or institution, may default within 1 year, 2 year or 5 year, 10 years, because the longer the period, the chance of default is higher, whereas the shorter the period, the chance of default is lesser. That's what we can anticipate. So the risk is almost low. So capital safety, this if you are having emergency fund, the best product to invest your emergency fund is ultra short duration fund, and the returns varies from 6.5% to 8.5%. Yes, recently they beat the returns of fixed deposits also, so we'll discuss that in this video. And liquidity, no issues. There is no penalty on premature liquidation. T+1 settlement is in place. So whenever you sell the debt funds, you will receive the money within the next day. So that is one good point about ultra short duration fund. Best for 3 to 24 months goal, cash reserves with returns. Risks, low risks. As I said, the maturity is 3 months or 6 months for the products in which this amount is invested. So this one good advantage short duration funds have. Now let's challenge the conventional wisdom. Well, FDs are widely perceived as super safe, but not. Here's why they might not be the best choice for your hard-earned money, especially for your crucial emergency fund, or if you're holding cash for the big flat or car or child marriage, whatever it is. The FDs are not fully risk-free. Only 5 lakhs per bank is insured under DICGC. Anything above is exposed if the bank fails. So in case if you invest 1 lakh, 10 lakh or 1 crore, you're insured only up to 5 lakhs. So if you made an FD of 1 crore rupees and bank defaults, then bank is supposed to pay only up to 5 lakhs. So 95 lakhs is still at risk. So that's one disadvantage what fixed deposits and saving accounts have, because they only up to 5 lakh rupees the interest, up to only 5 lakh rupees the bank is guaranteeing in case if they default. So most people, what they do is split for safety to protect 10 lakh rupees. If you are having 10 lakh rupees, you must split into across 2 banks, which adds again administrative work and monitoring. So this one disadvantage is there. Liquidity penalties in FDs, early withdrawals usually comes with 0.5% to 1% interest cut, not ideal for emergencies. And now coming to USDF, that is ultra short duration fund, fast access, offers T+1 liquidity, money arrives next business day, idle for emergencies or sudden purchases. FD single point risk. One bank's health determines the safety of your money beyond 5 lakhs. Before you invest into fixed deposits, the critical point what you have to consider is bank's healthiness, liquidity ratios, solvency ratios. These should be looked before you make an FD into any bank. Like if you go and make a FD in small banks, because they attract higher interest rate, at the time of default you might your entire capital might be in the risk. So this one critical point what you have to check before you make an FD into any bank. Now USDF is equal to diversified and expert managed. So this USDF is a mutual fund. It is a type of mutual fund which is a debt fund invested across many short-term high-quality instruments. Generally you have to check whether the fund manager is investing in high-quality instruments like A+ graded, AAA graded or A1+ graded instruments. Lower risk via diversification and professional credit evaluation. So the professional manager manages it, so you can be secured at that point, on that point. So let's quickly look the FD interest rates in India from 2013 to 2014. 2013 to 2024. So 10 years data we are presenting here. So 2013 to 14 it is approximately 9%. Average FD rates are 9%. From there, it slowly started dropping to 7%, 7.5%, 6.25%. Now probably we can take average FD rate as 6%. Let's now compare this with ultra-short duration funds. So these are consistently around 8.2%, and then they drop it to 7.65%. Now last few years, surprisingly few ultra-short debt funds actually gave returns up to 10%, 8% and 10% also there. These are average numbers we are showing here. But if you look at Nippon or UTA ultra-short duration funds, those returns actually are above 8%. So why ultra-short debt funds delivered that returns past 2 years? That we have to look at. Why USDF returns were high recently. Now let's talk about powerful, often overlooked benefit of USDF that FDs simply don't have, especially if you are a strategic investor. The ability to offset capital losses. The USDF tax advantage, yes, it still exists. Short-term capital loss. This 50,000 loss you can offset with gain investing in USDF, that is ultra-short debt funds, is 1 lakh. Short-term capital loss. So 1 lakh minus 50,000, the balance 50,000 is the only amount which you have to pay tax upon it. Like suppose if your net effective tax rate is 10%, so probably you will pay 5,000 rupees out of 1 lakh gain in the USDF. That one advantage is there. Whereas in case FDs, if your interest income is 1 lakh rupees, you cannot use the 50,000 short-term capital loss to offset this 1 lakh. So you need to pay 10%, 10,000 rupees over for the FD interest income, because your net effective tax rate is 10%. So this one crucial advantage what you have over FDs to USDF. Let's do the final comparison. So futures, saving account, fixed deposit, ultra-short duration fund. Saving accounts anyways ruled out. So we have two options for short-term investments, particularly to invest in something capital safe and deliver higher returns than inflation rate. The better alternatives are fixed deposit and ultra-short duration fund. That's it. Thanks for watching our video. If you have any queries or clarification required, please post your comments. We will reply to your questions. Please like, share and subscribe to our channel.